Okay, so the second thing is we don't want to reduce the coverage. We'd like to keep the coverage at $200,000, but we still want to be able to withdraw some money. So this is the second part of how we do a partial surrender, what we call a policy withdrawal. So as always, when we do these kind of things, the very first thing we have to do, obviously, is calculate the prorated adjusted cost base, okay, the prorated ACB. And that is the amount withdrawn, the formula itself, okay, is the amount withdrawn, okay, divided by the actual original cash surrender value times the original adjusted cost base. Okay, so these two are the originals, and that is the new amount basically that we're actually taking money out, okay. Once we've calculated the ACB, the next thing, of course, we have to look at the policy gain. And we look at the amount of withdrawn, again, minus that prorated ACB. This is where you've got to remember that. That's why we always start with the prorated ACB to calculate that first. So take the amount of money you've actually withdrawn divided by the original amount of cash that's actually sitting in the policy times the original ACB. We calculate that, and then we do the policy gain, which is the amount of money you're actually withdrawing minus the, of course, the new ACB, the prorated ACB. So we go back to Jessie here. Jessie has a universal life policy of $200,000. Her ACB was $65,000, and her cash surrender value was $80,000. So that's essentially the scenario. And what she wants to do now is she doesn't want to cancel the policy. She just wants to take out $40,000 from that 80. She'd like to have $40,000 in actual withdrawal, not a loan or anything, just simply a withdrawal, basically. So as I said, the very first thing we have to do is calculate what is the ACB. So in this case here, prorated ACB is $40,000, which is the amount of money that she actually wants in this case, divided by the original CSV, which was, remember, $80,000, okay, times, okay, the original ACB, which was $65,000, okay, so in this case here, $65,000. So that basically, if you do the math on that, that comes up to $32,500. So she's, basically, that is her new prorated ACB. So the original ACB was $65,000. Now the prorated ACB is $32,500. So basically, that means that anything in excess of $32,500 will be considered a policy gain. So quite simple, we take the policy gain, which is the $40,000, which Jessie took out, minus again her prorated ACB, which is $32,500. She got $7,500 actual policy gain. So a taxable portion now, $7,500 is her gain, her policy gain. She's in a marginal tax rate of 35%, 35% of $7,500. She has to send Ottawa $2,625 on this particular transaction, okay? So again, just a very, very quick summary. When you're doing a policy withdrawal, the very first thing you do is you've got to calculate the prorated ACB. So you take the amount of money you're actually withdrawing, divided by the amount of money that originally was in the policy, times the original ACB. Okay, so that's how you come up with the prorated ACB. Once you've done that, so that's what we did here, okay, we said we had $40,000 is what we actually took out. Originally we had $80,000 sitting in the policy itself, and the original ACB was $65,000, so we did all that. And the new ACB now for that loan, remember for the loan, is $32,500, okay, or I shouldn't say just loan, but withdrawal, which is what we're talking about here, okay. So withdrawal, whether it's a loan or whether withdrawal, it amounts to the same thing. You've got a $32,000 basically policy gain, ACB basically. So she took out $40,000 in actual cash, sitting in there, minus the $32,500 ACB, which of course is tax-free. So the taxable portion really is the policy gain. This $40,000 minus $32,500, which in this case is $7,500. Then you multiply that number by her marginal tax rate of 35%. So she has to send a check to Ottawa for $2,625. Okay. So those are the two mechanisms that we use when we're talking in terms of either a reduction of coverage, okay, in other words, when we're doing partial surrender, it could happen when you actually reduce your coverage, but it could also happen if, in fact, you leave the coverage where it is, but you make an actual withdrawal of money. That also creates a partial surrender as well.